All right, let's jump right into this explainer. Right now, we're seeing this massive, frankly dangerous disconnect in the global fixed income market. I mean, millions of retail investors are piling into bonds thinking it's the most obvious, safest bet of the decade. But today, we're going to break down exactly why this current yield environment is absolutely not the safe harbor you might think it is. The data actually tells a completely different story.
So if you've been buying bonds just waiting for rates to drop, we really need to ask a critical question here. Are you taking a small calculated risk, or are you facing a swift, total wipeout of your yield? Retail sentiment is so heavily anchored in this buy-the-dip mentality right now. But the hard data? It suggests that if you're buying long-duration sovereign debt today, you aren't just catching a falling knife. You're essentially positioning your portfolio directly underneath a mathematical guillotine of rising real yields and accelerating inflation.
And the market is just laser-focused on this specific nominal yield for the 10-year Treasury, 4.446%. Now, this number is arguably the biggest value trap in finance right now. Psychologically, I get it. It feels like an absolute bargain. If you think back to those dismal 1% yields we were all stuck with in the early 2020s, locking in over 4% feels like you're pulling a fast one on the market, right? But relying purely on this nominal number completely masks the underlying macroeconomic forces that are quietly setting up a sharp, sudden capital loss.
Which brings us to Section 1, the rate cut illusion, and why we're dealing with an outdated 2025 consensus.
You see, the widespread expectation that rate cuts are just around the corner is actually a relic of a completely outdated mindset. A lot of investors are still operating under the assumption that inflation is beaten and the Fed is just waiting to turn the taps back on. But the structural reality has flipped 180 degrees. To really get this shift, we have to compare the old macro environment of transitory supply chain issues with the brutal new reality of a fundamentally restructured inflation floor. Think of it like this. Pandemic-era inflation was like a massive traffic jam. Used car prices spiked, lumber went crazy, but eventually the cars moved and the road cleared. What we are dealing with right now is not a traffic jam, it's a bridge collapse. The global energy shock is fundamentally rewiring the route. The old baseline assumed inflation would just gently glide back down to 2%, but this new baseline is dictated by structural supply deficits that make that 2% target mathematically impossible without triggering a severe recession.
So let's move to Section 2, the Hormuz energy shock and systemic disruption.
This leads us directly to the geopolitical catalyst that's rewiring the global economy, the profound disruption in the Strait of Hormuz. We're looking at a mini-war that is so much more than just a localized event. It's a systemic shock to the very building blocks of the global economy, altering commodity logistics and resetting the inflation floor for the whole world. When you look at the acute near-term scarcity being projected, it's genuinely eye-opening. You've got major institutions, the Energy Information Administration, the World Bank, the CME Group, moving in absolute lockstep. They are all projecting massive spikes well past $111 a barrel. This is not a temporary blip. It's a violent, energy-driven inflation shock that cascades into literally everything, from shipping costs to the price of your groceries. And a 90% drop in maritime traffic through this specific corridor isn't just a scary headline. It's functionally equivalent to pinching the main artery of global commerce. Roughly 20 to 25% of global seaborne oil traditionally moves through this tiny 21-mile strait. And here's the kicker. You don't even need ships to be physically attacked to close it down. Skyrocketing insurance premiums basically do the job for you. By functionally closing this route, millions of barrels of oil are stranded or have to be rerouted, which drives headline inflation right back up to 3.3% and beyond. The Federal Reserve simply cannot ignore an artery blockage of this magnitude.
Now for Section 3, the Fed watch hike pivot and the massive gap between retail and institutional investors.
This right here is the institutional alpha. This is the massive, glaring gap between what retail investors believe and what the mathematical reality actually is. And it's exactly where the risk for the average investor hits a boiling point. Back in January, the market priced in an overwhelming 85% chance of a rate cut. Fast forward just a few months to May, and that probability completely collapsed to 1.5%. At the exact same time, the probability of a rate hike surged from absolutely zero to nearly 33%. Going from an assumed in-the-bag victory over inflation to a 1 in 3 chance of the Fed actually raising rates again, that is a catastrophic narrative failure for the buy-the-dip bond crowd. The smart money is no longer waiting for a pivot to cuts, they're actively bracing for a pivot to hikes. Because instead of providing relief, the Federal Reserve is essentially paralyzed by these upside risks to inflation. They're staring down a classic stagflationary trap, rising prices driven by energy, paired with weakening labor markets. And here's exactly why they are frozen. If the Fed cuts rates right now to help out a struggling job market, they will literally pour gasoline on the energy inflation fire. As long as the Hormuz conflict continues to drive up the cost of imported energy, they are mathematically forced to maintain a restrictive, higher-for-longer stance for a much longer duration than anyone originally anticipated.
Let's dig into Section 4, the duration risk guillotine, and how this mechanical trap works. Now we get into the granular, frankly brutal mathematics of your portfolio. This is the mechanical trap that catches investors who just stare at that 4.4% nominal yield and completely ignore the underlying price sensitivity of the bond. So let's walk step by step through this math using a concept called duration. I want you to picture duration like a seesaw on a playground. The longer the maturity of the bond, meaning the further out you sit on the seesaw board, the more violently your price swings down when interest rates go up. For a 10-year Treasury, the duration is about 8.5 years. What this means in plain English is that a mere 50 basis point hike from the Fed pushes your end of the seesaw down hard, causing a capital loss of roughly 4.25%. So, you think you're safely earning a 4.4% annual yield, but that single 50 basis point hike instantly vaporizes nearly a full year of your hard-earned interest income in the blink of an eye. To put that true carnage into perspective, let's apply it to a standard $1 million portfolio. If yields push higher by 100 basis points, meaning they move up toward 5%, the resulting 8.5% price decline completely neutralizes 2 full years of yield. It would cost that $1 million portfolio $85,000 in pure principal. Earning 4.4% sounds fantastic, right up until your principal drops by 85 grand on a random Tuesday afternoon. Suddenly, that yield isn't paying you. You are paying for it. This is exactly why we call it a guillotine. The nominal yield provides this false sense of security, while the macro environment steps in and delivers a sudden, massive capital loss.
Which brings us to Section 5, the real yield trap, or what we call the purchasing power illusion.
We really have to peel back the layers here to expose the silent killer, inflation eating away at the actual, real-world value of the money you get back. When you juxtapose that safe, nominal yield against real yields, a terrifying truth emerges. Real yield is what you actually get to keep in purchasing power after inflation takes its cut. Now, if oil sits at $70 a barrel, your real yield is a decent 2.4%. But watch the psychological breaking points as oil climbs. Once we cross the $100 threshold, things get incredibly tight. And if oil sustains at $130 a barrel, driving implied inflation up to 4.9%, your real return on that 10-year Treasury actually goes negative. Specifically, negative 0.454%. Just let that sink in for a second. You are locking your money up for an entire decade just to guarantee that you get poorer. Your quote-unquote safe investment is actively destroying your wealth.
And there's another layer to this. The potential transition to Kevin Warsh at the Federal Reserve brings this massive, looming risk of the central bank using what are called trimmed mean inflation metrics. Let's break down what that actually means in reality. A trimmed mean essentially just throws out the extremes. So if food and energy prices suddenly spike, the Fed might just cover their eyes, ignore those inconvenient outliers, and declare inflation tamed just to justify a rate cut. For a bondholder, this is an absolute nightmare scenario. It lets real-world, everyday inflation run completely hot while the Fed takes a victory lap. This unanchors long-term inflation expectations, forces long-term yields even higher, and dramatically deepens the capital losses for anyone caught holding a 10-year Treasury.
So let's move to Section 6, navigating the volatility and establishing a new framework.
So, what does this all mean for us? How do we successfully pivot our mindset and protect capital in this 180-degree reality shift? Well, we absolutely cannot rely on the old playbook of just buying long-duration debt and waiting for the central bank to ride in and rescue us. The smart money right now is moving toward institutional-grade positioning in 3 very distinct steps. First, reduce duration. Move to bonds where maturity is under 3 years. Remember the seesaw analogy? You want to be sitting closer to the middle so your price doesn't violently swing when rates move. Second, utilize TIPS, Treasury inflation-protected securities. This is your direct mechanical hedge against that Hormuz energy shock. And third, maintain your cash flexibility with quasi-cash instruments. You want to have dry powder ready to deploy for when the 10-year Treasury actually hits an honest, properly priced valuation.
I want to leave you with this final thought to chew on. The market has entered a period where the old rules simply do not apply anymore. In an environment that is fundamentally restructured by systemic energy shocks, shipping blockades, and a stark institutional pivot toward rate hikes, are you still trading the ghost of 2025? Because as long as geopolitical choke points are dictating global inflation, that 4.4% yield is not an opportunity, it is a trap, and it's just waiting to be sprung. Thanks for joining me on this explainer, and stay sharp out there.